You know those kung fu movies where they go higher while making any moves? It's not like the punch or the kick is any different because of the sound effects, but it sure feels like the impact is so much more. The way the RBI controls interest rates is a bit like that. There are three ways it can do it. First, by delivering the actual punch, that is, by increasing or decreasing the policy interest rate or the repo rate. This is the rate at which banks can borrow from the RBI. Second, and this is the higher bit, is by the RBI governor telling what he expects to do to interest rates in the future. So if the governor says, look, inflation is a problem, we have to be very alert, markets will interpret this as maybe the governor wants to increase interest rates more in the future. So then market interest rates, be it on government bonds, eventually on loan rates, deposit rates, all face upward pressure. Conversely, if the RBI says, hey, I'm actually more worried about growth than inflation, we need to ease financial conditions, the reverse happens. Interest rates start moving lower. Mind you, all of this is happening even as the RBI keeps the actual policy interest rate constant. This is literally just by the power of words of the RBI governor. And the third, higher way is by controlling liquidity. Now, liquidity is a bit like water in a fish tank. If you drain away the water, then the fish will be struggling for space and breath. Liquidity, broadly speaking, is the amount of money floating in the system. So every day, banks, for instance, lend and borrow between each other, often just for a day. So some banks with excess money at the end of the day, say someone has come and made a big deposit at the end of the day, the bank can't, of course, lend it away immediately. So what does it do? It can either park it with the RBI or it can lend it to another bank who might need that money, typically at a higher interest rate called the call money rate. In theory, this should be close to the policy repo rate. After all, the repo rate is the interest rate at which banks can borrow from the RBI. So the call rate, which is the rate at which banks can borrow from each other, should technically be close to this rate. But look, if liquidity becomes too tight, then the amount of money sloshing in the system becomes too less. The fish, or in this case the banks, become panicky. And so the call money rate starts to trend above the repo rate. And ultimately, if banks are having to borrow from each other at higher interest rates, well, they will also be inclined to lend that money out at higher interest rates to you and me. So, by controlling the amount of water in the tank, the RBI can deliver higher or lower interest rates in the system, again, without officially changing the policy interest rate. Now, to be fair, liquidity is not entirely in the RBI's control. For instance, when the government is paid GST every month, there's an outflow of money from the system, so liquidity reduces. When the government decides to spend, there is an inflow of money in the system, so liquidity increases. When festivals come and people do more cash transactions, again, liquidity is sucked out from the banks. And the call rate is like the needle of the ECG machine. Whatever little flutter in demand and supply of money happens, it gets captured in this ultra short-term interest rate. But that said, the RBI can also do a great job in manipulating liquidity. How? Well, let's say banks are sitting on excess cash. The RBI can do auctions to allow banks to park that excess liquidity with it at a suitably remunerative interest rate. The RBI can also decide to sell some of its stock of government securities. So what happens? Banks pay for those securities with money, and so their liquidity reduces. The reverse happens when the RBI buys government securities from banks, because it is then pumping out money in exchange, which is injecting liquidity in the system. These are, by the way, called open market operations. I mean, RBI can also raise something known as the cash reserve ratio. This is the minimum amount of money that banks are forced to park with the RBI by regulation. So if the ratio is increased, then effectively the liquidity is again flushed out of the system because banks cannot lend that additional amount anymore. Even when the RBI buys or sells dollars to control the exchange rate, I mean, After all, if you're buying dollars, you are ultimately selling rupees. And if you are selling rupees, the amount of money in the system goes up. So remember, all of these are hayas that are happening even as the central bank keeps the policy repo rate the same. So it's currently at 6.5%, but by just tightening the screws on liquidity, the average call rate by end November was around 6.8%, which is essentially as good as the RBI delivering another rate hike of around 0.25%, which is the usual quantum by which central banks typically raise interest rates at one time. So it's like a rate hike literally happened in stealth. So here's the RBI's problem. Stopped hiking policy rates from February 2023 onwards. So after raising it from 4% in the previous year to 6.5%, it realized that India has reached that level of interest rate beyond which growth will be hit too much to control inflation. But the problem is that markets might start to think that, hey, interest rates will come down from here because the RBI is done hiking. Because the way it works is that a central bank hikes policy interest rate, finally sees inflation come under control, settles there for some time, and when it is fully convinced that inflation is fine, growth needs to be rescued, it cuts. So when a central bank stops hiking, naturally everyone in the market is like, when are they going to start cutting now? But that would be detrimental to the RBI's objective, because as much as the RBI does not want to raise interest rates, it also doesn't want to reduce them, because inflation is still hovering in India in the 5 to 6% range while the official target is 4%. So what does the RBI do? It keeps doing hayas whenever it meets every 2 months to decide on interest rates. So it has been keeping the policy rate constant, but has been giving bond markets all kinds of indications that it wants to keep liquidity tight and that interest rate hikes are not over. And in the process, it has delivered two back-to-back horror movies for the bond market. In August came out Conjuring 1, where the RBI unexpectedly said that, listen, I am temporarily increasing the cash reserve ratio. Now, if you recollect, this is the amount that banks have to compulsorily park with the RBI. It did so because the 2000 rupee demonetization had led to people depositing their money with banks. So banks' liquidity went up, and the RBI was worried that, hey, this is too much money sloshing around in the system. Interest rates might face a downward pressure. So it said, nothing doing. I am forcing you to keep this excess money with me. Again, markets had not expected that the RBI was so cross with liquidity. So interest rates went up. Conjuring 2 happened in the next policy meeting in October. Out of the blue, the RBI governor said, we are going to do open market operation sales of government securities. So again, RBI sells government securities and by doing so sucks out money from the system. Now, it's hard to explain this to outsiders, but for the bond market, the RBI governor coming up and explicitly announcing that it will do these open market sales without warning, it's the equivalent of bringing a bazooka to a knife fight. And it petrified markets. Because analysts were doing calculations and were like, hey, liquidity is already going to be tight in the next 2 months. Why is the RBI saying that it wants to tighten more? So you can imagine, if you're a bank that needs to borrow money, not only is the available water in the tank already low, but the guy running the aquarium just told you that at any time he plans to suck out more water. Obviously, the call money rate, which is again the most sensitive interest rate out there in the system, spiked up. Eventually though, the analysts turned out to be right. Liquidity was already so tight because of the regular demands of the day-to-day running of the economy that there was actually no need for the RBI to suck further of it out. So it turned out to be an empty threat. But here's the thing, it was a threat. And threats like this, they're like Damocles' sword hanging over the market. Because anytime interest rates can go up further. So by the time the December meeting was due, markets were like kids in a horror movie. What skeleton is going to jump out at them from the dark this time? What new trick does the RBI have in its mind to shock short-term interest rates higher? So everyone had their eyes tightly closed with a single slit open, wondering, ab kya hoga? And instead of conjuring three, the RBI delivered a Dilwale Dulhaniya Le Jayenge. Nothing remotely horrific. Said the usual things, that it sees inflation high, that it is exceptionally positive about growth. In fact, after the latest GDP growth figures, it raised its FY24 forecast for GDP growth from 6.7 to 7%. By the way, we've recently done an episode of The Bond Economist on the good, bad and ugly of India's growth story. I'll leave a link at the end. And if a central bank is saying that it sees growth very strong, it means that there's actually no need to reduce interest rates to rescue growth. But interestingly, the RBI also said for the first time that it shouldn't over tighten, which is a curious sentence to slip in after spending the last few months scaring the wits out of the bond market and manipulating interest rates to move higher. And so when markets realized that there were no ugly shocks on liquidity, that there's no change in terms of the RBI's interest rate messaging, they gave one large momentous phew. For more such insights, like, share and subscribe to The Bond Economist.